And welcome into the Roundtable. And one of the things we've been talking about in recent days is the interesting crunch in starts in terms of the warehousing industry and where things are going along those lines there as well. We've got a couple of people here who can talk about how we're going to handle this interesting situation. First off, joining us from Kansas City, Missouri, we've got Joe Arliaro, VP of Sales and the Chief Real Estate Officer for Wagner Logistics, and then also Ryan Schreiber, the VP of Growth at Metaphora as well. Gentlemen, thanks so much for joining us. Let me throw up a chart that we had up last week. Guys, this is something that came as a bit of a surprise in terms of how things went. These are warehousing starts as they've appeared, of course, in the past few years. And you can obviously see that we increased a ton during the pandemic, and then all of a sudden now we've had this kind of catatonic drop-off at this particular point. And Ryan, let me go first to you. In terms of what you're seeing as you look at this chart, obviously, is this a market that is just simply oversaturated and this is a bubble that is bursting, or is this simply a need that is not seen anymore?
First of all, always dangerous to come to me first, but I appreciate the willingness to take a chance.
We haven't had you on in a while, so I figured to give you first shot.
Yeah, I mean, let's see if we can get this things off the rails right away.
Sure.
Here's what I would say. When I look at the charts, when I read the articles that Freightwaves put out over the last couple of weeks, it doesn't really surprise me when we're looking at this. Really, this industry, trucking, logistics, warehousing, and how the major market-making shippers really kind of engage this market, it's always very reactive, right? And so we've seen a downtrend. We've seen inventories kind of catch up. So, of course, everyone goes into a hole. And then when you look at some of the broader macroeconomic stuff, interest rates going up, money's just harder to come by. Banks are always risk averse, right? That's just a statement of in perpetuity, death, taxes, and banks not wanting to lend money. Those are all things that suggest, reactivity. There's challenges in getting capital. And then we're going into an election year where everyone is always also a little bit more kind of trepidatious, if you will, in terms of taking risks or investing in growth until they see what happens. So I don't really see anything that surprises me specifically when you look at where we are in the market cycle, where we are in the economy, and where we are in the election cycle.
So, Joe, from your perspective, you look at that chart again, obviously we came from an amazing high and we've dropped down just extremely quickly here. Some people can say, obviously, freight is, as Ryan mentioned, we are a lovely industry that loves to overreact. But what do you see when you look at that?
I see a dip in the cycle. It's just it's a normal thing in real estate over, we'll call it a 10-year period, because that's kind of what we're looking at. And I think Ryan hit it on the head. You've got a lot of people that are risk averse. They don't know what's going to happen after this election. There's also a lot of unknowns with forecasting. I mean, over the last 5-10 years, we've really started to get a lot more data when it comes to how to handle product. And we've seen, specifically within Wagner, we've seen customers, not willing to sign longer term contracts just because of that. And I think that trickles down to the landlords that they're either leasing space for or leasing space with, or that we're taking down space. And it trickles down and you can't build these big box facilities without long-term leases in place. It just doesn't cash flow and you won't be able to get the money for it. So it's just a typical dip in the cycle. And I think as the demand starts to increase over the next 5 years, and I say over the next 5 years, so there's a lot of onshoring activity coming back to the U.S. for manufacturers over the next 5 years. And, that there are 68 different markets across North America that are going to require 10 million square feet or more over the next 5 years to facilitate that growth. And so I think that's going to be your upswing. That's where you're going to see a lot more people building spec buildings and really taking higher risks once interest rates kind of tail off and we start to see the light at the end of the tunnel.
Ryan, we had a conversation not too long ago, and I asked you a question about if you thought the pandemic made the industry as a whole kind of paradigm shift a little bit. And you said at the time, probably not at this particular point. But as you look at a chart and other data like that in terms of how we're kind of reacting and getting through the pandemic and getting back to what most people think is, or at least some sort of an idea of consistency after this point. Is this kind of the situation where you're looking at a bubble that there was just so much need, all of a sudden now there's not any need, or is this an area of concern for people that say may need the space and we're crashing and they're not going to get it?
Yeah, I mean, I think it's probably too early to call it a bubble bursting. I think it's too early to call it, that kind of extreme of a scenario, right? Those are the kind of things that you can only really know when you look back at it, right? Have we hit the bottom of a market cycle? Is a bubble burst? I think that is all too early. I think there are, it's an Occam's razor type situation, right? And there are a number of very reasonable explanations for why things are the way that they are without going to an extreme of a bubble has burst, vote for Chicken Little in 2024 because the sky is falling. Here's a good example of that. I mean, one of the things that the Freightwaves article said that we referenced at the beginning was talking about sort of like markets like the Metroplex DFW where there's plenty of space. Well, there's plenty of space, but the infrastructure around that's, there's plenty of land, but the infrastructure around the land has to grow to be able to accommodate facilities, right? And that's a step sort of sequential thing that needs to happen. If I build a warehouse in where I live in Georgetown, Texas, in my backyard, perhaps, I'm pointing to my backyard and looking at it, which is why I'm doing this. No one can get to it, right? There's plenty of space all over the place. We have, you have shopping malls over the last 10, 15 years that have closed that are just empty as retail behavior has changed. But there's a reason that those things haven't become major distribution centers, right? And that's infrastructure. So that's even just one more reason to look at a situation that says, let's pump the brakes here. This is probably a normal, reasonable market shift. And then as you and I talked about, when we had that conversation, Bill, and as my colleague here was just saying a minute ago, there are things that are still in flux that will play themselves out over the next 5 to 10 years, right? Like nearshoring, onshoring, like shippers de-risk, even to the extent that they do remain global, de-risking trade lanes, right? With global instability, with climate change, things like that are going to continue to drive these shifts. And then it's reasonable for manufacturers and retailers to say, hey, we need to see where we're going to need stuff, right? Where's the population going to move as we look at nearshoring? How are those trends going to accelerate or decelerate? Gotcha. So, let's take a pause on maybe bursting bubble. One man's opinion.
Okay, Joe. Looking back at that, there's as you see it, obviously that chart indicates, obviously we said a massive drop off. Obviously, it could be there a shift as well. But a drop off that quickly, I think, has to hurt somebody at some particular point. Is there anybody that you see that might be at risk? Not necessarily Wagner customers, but anybody that might look at that and go, oh, we could be in a little bit of trouble here.
I guess I think of it as, you don't want to be the last developer building a building at this point in the cycle when the interest rates are super high. You may not have. If you are able to fill it, your returns aren't going to be as high. So I think if you're going to see any kind of bubble, you're going to see some developers or some landlords having to turn their buildings over to the banks, and you're going to see some folks get in trouble over that. Mostly because the interest rate's too high, and it's just cheaper for them to turn it over to their lender and kind of walk away from it. So you will see some of that, and that will hurt some developers out there. But I think that's probably what's top of mind for me in that regard. And I think what we're also seeing is a struggle to market entry from a 3PL standpoint. So typically in a lease, you'll see a 3 to 4% annual escalation in your lease rate if you sign a lease. Market rents, however, have increased at 8 to 15 to 20% in some markets year over year. So if you're trying to get into a market as a new market entrant 2 years after one of your competitors has signed a lease, you're already 16 to 20% behind the eight ball when you're quoting storage rates. So it's made it a real challenge for 3PLs to get into a new market against a competitor that may have available space that they can sell.
Certainly an interesting situation. Really quickly, Ryan, do you see this as a quick recovery or one that's just gradual as it comes back?
I probably gradual, but then again, everything in this industry tends to be kind of peaks and valleys. So I could certainly go either way.
Gotcha. Joe, quickly or gradually?
Gradually. I think we'll be there soon enough. It's nothing like Brian said, just nothing chicken little.
Okay.
Nobody's going to sign up for the chicken little theory.
2024. Get the
There
sign.
you go.
Put in your fridge.
That's right.
Joe and Ryan, thanks so much for joining us on this roundtable. Obviously, the situation we will take a close eye at as it continues to evolve. Thanks so much.
Thanks, Bill.
Thank you.
All right, let's move back over to Kaylee next with our last check of headlines for today.